what's saying here is maybe not too much. It's housing growth eases as affordability and rates loom large. So in the national home values, they've risen by 1% over September, the third consecutive month of strong growth, but it's easing from the 1.1% in October. So a little bit down, but still on that massive upturn. Mid-sized capitals are outperforming, with Perth leading the way. 2.4% growth, with Melbourne and Sydney lagging at 0.5 and 0.3 respectively, amid affordability constraints. As we were saying there, the affordability and rate pressures loom as record higher dwelling value to income ratios and expectations of prolonged rates hold signals headwinds for housing sentiment and credit access. Headline growth figures was weighed down by Australia's largest cities of Sydney only rising at 0.5 and Melbourne at 0.3, whereas every other capital city recorded a rise of at least 1% throughout the month. Tim Lawless noted that the growth in home values across the mid-sized capitals was once again diverging from larger cities, a similar trend to the one seen in late 23 and 24. The skew towards the mid-sized capitals is especially evident in Perth, where listings are holding more than 40% below average. That is, yeah, damn.
Massive.
Yeah. Buyer demand is elevated, and the monthly 2.4% rise in dwelling values added just over 21,000 to the median in November and 5,000 a week. So just going gangbusters, really. A lower monthly gain in Sydney at 0.5 could be reflective of the affordability constraints, putting a ceiling on the growth. Mr. Lawless pointed to the fact that Sydney has had a similar supply deficit, with listings tracking 2.2% below the 5-year average for this time of year. Where are we? 16% below average listings in Sydney, whereas the monthly growth rate looks to have peaked at 0.9 in August. So 0.9 down to 0.5 on that downward trend, like we were saying. Moving into the mortgage side of things. So Sandy, maybe we'll get you to comment on this as well. Another demand side factor that might be weighing on the housing growth moving forward is the rebound in inflation, as well as now widely held expectation that interest rates won't be cut any further time soon. The RBA's target range of inflation it's above where it's meant to be, and so rates will potentially hold for the foreseeable future. Impact of recent policy announcement from APRA to the high debt to income ratio holds 20% of new lending will also be limited. He noted that majority of the recent mortgage originations remain of 6 times the debt to income ratio. Obviously, this won't come into February, but we're already seeing the impacts of that now. November was a whole lot of fun. As we said, Perth is up there, but the changing in dwelling values, Sydney is up 5.1%, with median at 1.2 million. But Brisbane with a 12.8% increase in November. Perth with 13. Adelaide with 8.
Annual in the year.
Yeah. And Melbourne with 5. So it's all going up there. But yeah, median is Sydney with 1.2. Brisbane is now 1.1, overtaking both Perth and Melbourne. Perth at 914 and Melbourne at 823, and even Adelaide at 890. So yeah, Melbourne.
Perth third.
Perth is third. With Brisbane overtaking both Melbourne and Perth as well,
Yeah,
which I thought was very interesting.
We could get to the highest. 1.2 is going to be hard to get to, but we could do. We have been once before, you know. In 2007, Perth was the highest priced property in Australia in 2007.
And what happened after? So, what we're saying, downsides in factors include the record levels of unavailability and unaffordability, a growing expectation that interest rates will be held for an extended period of time, renewed cost of living pressures, and a fresh phase of of macroprudential credit tightening in the form of the off limits and high debt to income ratio. All of what we were saying here, with housing values rising at about 4 times the pace of wage growth, putting even more strain. Stable interest rates will exacerbate and serve the serviceability challenge. Just all the things which we've been saying, just adding that pressure that low supply levels will inherently take a long time to fix. It's just building and building that pressure. What are we saying? Perth weekly market snapshot. That's where we're focused. That's where we're looking at mainly. Perth transactions for the last week were down 4.1% with 937 transactions. There were 2,918 properties for sale at the end of last week. The top performing suburbs, Baldivis, Rivervale, Canning Vale, Dianella, and Lakelands. So a little bit of everywhere. And in the rental market, which we're going to focus on in a bit, of course, there was 2,246 properties for rent at the end of last week, with 715 properties lended in there. Massive performing suburbs was Perth with 27, then Baldivis, East Perth, Alkimos, and Maylands. So again, a whole lot of everywhere, and again, that pressure is just building, going. Rental markets remain extremely tight with no vacancy rates loosening. Nationally, the past 4 months have seen the rental vacancy rate hold it close to record lows of 1.5, down to 1.9% a year ago. With vacancy rates remaining low, rents are continuing to rise. The national rent index rose 0.5% in November to be 5% higher within the last 12 months. Ongoing rent rise is occurring against the backdrop of several rental affordability pressures. The latest quality affordability metrics estimate that the cost of rent equated to just over 1/3 of a household's pre-tax income, a new record high. Although rents are rising, housing values are continuing to rise faster, which is just putting some downward pressure on gross rental yields at just 3.58%. The national growth yield hasn't been this low in 3 years.
Well done. Round of applause for Matt. So let's have a chat about the market. Let's look at who we got there. Who we got? Where's our broker? Sandy.
Good morning.
Sandy, obviously listening to Matt there is significant pressures in the market, especially affordability with the pricing. I did also hear from what Matt told me, there's some new things coming into play with APRA, 20% minimum deposits. So tell us what's going on.
I try just to be straight up, I try not to speculate on what APRA and all those guys are doing. We deal with what they do. Do you know what I mean? So yes. At the moment, most investment borrowing is capped at 90%. Okay. They're actually going to bring it down to 80%. Okay.
Which it should be anyway. Let's be honest.
Look, it's a safer option. I'm talking to buyers agents and people using buyers agents, and sometimes the buyers agents will say, "Oh, no, top out their borrowing capacity," and I thought, well, that's actually good. But if they can get a decent property and have some equity available in that property, then that will help them to build the portfolio. So it's kind of like, sometimes the strategy of borrowing as much as you can is not always a good option. So 80% is actually, it's conservative, I think. It's not bad.
I've never bought an investment property with less than 20% deposit in my life.
You don't want to be paying mortgage insurance on it anyway. So, that's the main thing. That comes off your bottom line. It's extra money there that you could be using in equity. So, and it's not cheap.
And it's all good and well, Sandy, when the market's increasing, 10, 15% a year, when you're buying investment properties at 100% or 95% or 98%. But when the market pops, all of those properties are going to become unaffordable for these people.
Yep.
So it just wrecks the market.
Yeah,
But
what we
anyway,
found,
that's my two bobs worth.
yeah, no, what we found with the first home buy schemes a few years ago when they first brought those in, we were putting kids, single income kids, into 98% loans. And then the rates the market fell, and we couldn't refinance them to another loan because their loan to value ratio was too high. So they're stuck in these big interest rates, and we couldn't shift them. It was really it was horrible. It was horrible.
Yeah.
There's a few schemes around now that are very similar, or the same. So we're being very cautious with it, but there's a new one coming out next year, the Help to Buy scheme. Have
I
you heard of that
know.
one? It's not going to be available in West Australia for a little while, but it is going to be available. And that's another one, but that's shared equity. So, and it's expensive to get out of again. So there's a few things to get the people in, but it's hard for them to get out once they're in if the market drops. So it is a tricky one.
That's my worry. Now they obviously inflation's run rampant again, and the interest rates are being held, and we're being told that they're going to be held for a long time soon. Where rate cuts were probably more promised, but with inflation, it's just not going to happen. So tell us about interest rates and where they're likely to go. And is there any chance that they could go up?
Yeah, there is a chance they go up. Again, I try not to speculate. I deal with what comes, but you do see trends. Like at the moment, some of the lenders are putting up their fixed interest rates, which is a bit of a worry when they're doing that. When the interest rates have been about 4.98 to 4.99, something like that, for 2 years for a little while. But they're putting them up now, they're putting them up to about the 5.34, which is, very similar to a lot of the variable interest rates. So trend there is they're trying, there is in the market, journalists are telling us that the interest rates are going to go up. That kind of scares people into those fixed rates. So it's another situation where it's very much a gamble at the moment because the interest rates are not very different. So if you were going to fix to a 5.34 for 2 years, say, and then the interest rates drop again, then you're stuck in that rate for 2 years. If you don't and the interest rates go up, then happy days. So it is a real gamble at the moment. It's a hard one. It's a 50-50 kind of thing, It's what your risk appetite is.
But it is a bit of cracking in the damn wall, isn't it? When the banks are starting to offer fixed rates. They obviously got their finger on the pulse more than anyone. So if they're going, oh, okay, well let's offer a fixed rate, and
It's usually the way. It's usually the way. If they're locking in.
Cash rates down. So yeah, it's a very interesting. I've never seen a market like this ever in my 25-year real estate career.
It's crazy.
But I am seeing similar signs of what I've seen before.
I don't think we'll ever see those really low rates again, the 1.9s and the 1.89s. I don't think we'll see those again for a long time if we do.
No.
They were just unbelievable. I mean, I've been around 20 years, and that was the first time I'd ever seen anything under 3%. It was just ridiculous.
Well, that was crisis time, wasn't it?
Yeah.
Yeah.
But it sucked a lot of people into different loans that potentially in the years to come they couldn't afford. So it is really tricky. But that's just the market. That's how it is. It is what it is.
So you being part of the Real Estate Brilliance crew, obviously, are you're able to take on some clients and help people with their loans, their
Absolutely.
clients?
But one of the things I do want to say is I understand a lot of agents have already got relationships with brokers, and I'm not here to break those. I don't want to get involved with that. If you're using a broker, fantastic. That's the best way to go. Don't go to the banks because they don't tell you if someone's better down the street.
Yeah.
But if for any reason you need some help with something, conversation costs nothing. And I don't, even with clients, I find with the real estate agents I deal with, I always say to them, look, if the clients tell you they're already pre-approved, just ask the question, is that with a bank or with a broker?
Okay. Yep.
If it's with a bank, give me their phone number. I'll give them a call, make sure they've got the right product. And if they haven't, I'll put them on the right path. If they have, I'll go happy days. It's going to be a strong deal.
Yeah.
So, it just reassures you that that contract is going to go through. But yeah, I'm happy, open to conversation and phone calls for sure.
Now, obviously, a lot of these phone calls for agents tend to happen at home open time, Saturdays and Sundays. Are you happy to take a
Yeah,
call on a Saturday and a Sunday?
absolutely.
I know with Terry, he was amazing, and I used him a lot um, to 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 qualify whether I could get this property under offer or not.
Yes.
And he would go through with a buyer, and he would come back to me and say, "Look, Ryan, I think it's a deal,"
Yep.
inevitably it was. Or you'd say, let's. I'm going to need some more information from them, so maybe don't stick it under offer just yet. Let's clarify some
Yep.
debt or whatever the case may be. So it's a huge. I've found having a broker, a great relationship with a broker, a massive asset in my business
Absolutely.
and nobody likes fallovers, and that one phone call is just that little bit extra to go this. And sometimes we get a curveball like contracts is a good one, like they're on a contract. So how long's the contract? Are they coming out of another contract? What industry is it? You guys know that stuff, we don't.
Yeah.
Whereas you can pick it.